Right, hello and welcome to our Miller Rose UK Budget 2025 update. I've got guest speakers here who are experts in their fields. And before I start, I'd just like to say this is probably the most leaked budget that we've ever had in the UK, but to most of us, it's not that scary and it's been pretty straightforward. So look, in today's budget overview, we're going to look at how the budget is going to affect you as a purchaser. We'll look at the changes in what that means for overseas buyers, landlords and investors. And then we'll look at some of the key tax considerations you have to take into mind. And to reinforce this, we have our mortgage and finance specialist who will relate these topics back to answer any further questions around our tax side. My name is Gareth. I work for Miller Rose. I'm the sales director based out of Asia. I specialize in high yield investing around the UK. I've got over 25 years experience in selling new build homes, and I've also extensively covered areas like Thailand, Malaysia, and Australia, as well as being actively involved in the Hong Kong market too. We're lucky enough to have Richard Jepsen. He is our tax manager and panel specialist from Adams and Moores. Richard is a qualified UK tax accountant with over 10 years experience working with UK residents investing into the UK market. Adams and Moores are a qualified UK accountancy firm, and they have a specialist non-resident landlord department, which is excellent for our expat clients. And each year they submit around 2,000 tax returns for their clients earning rental income in the UK. Richard also regularly travels between Hong Kong, Singapore, Malaysia and Thailand, where they have an office in Malaysia. Gavin is the Asia Pacific Director for Capricorn Finance Consultancy. He'll cover our finance side today. Gavin has been working with UK buyers for over a decade and has been based in Hong Kong for 5 years, assisting non-UK residents get their UK financing for property. Capricorn is a financial leader, London's largest independent mortgage brokerage, and they have access to ensure that you get the best coverage of all finance options in the market. So look, to move on, we'll just jump straight into it. I will put the first question to Richard, our tax specialist. We're going to start with income tax, which is the obviously the main one in the budget that's been most talked about. It's the additional 2%, which is aimed at the landlord in the UK. So without further ado, I'll let you get started, Richard. Please give us your thoughts.
So property taxes, there'll be a 2% increase starting from April 2027. So anyone who would have normally paid 20% tax will then pay 22. Anyone who would normally paid 40 will pay 42, and the highest rate of 45 goes to 47. So yeah, I mean, it is what it is, unfortunately. Gathering all the rumours that were coming prior to the budget, I think the 2% increase, in the grand scheme of things, is probably actually we think we got off quite lightly. I think it's okay. It's just really down to sort of what else you can do about it. Ultimately, for someone who says rental profits are up to say £50,000, you're talking an extra £1,000 of tax. If someone's got, £20,000, obviously be a lot less than that, a couple £100 worth in tax. So whether it's enough to sort of get you thinking about what else you can do, that's entirely up to you. Of course, there are options in particular for new properties you're looking to buy now, and the obvious one is using a company now more worthwhile. Bearing in mind, companies at the moment you can pay tax down at 19% if you do, for profits up to £50,000. So will be a 3% difference there now. So that could be enough to swing people towards companies. It may be that some people are just happy to sort of pay the extra 2% and keep things in their own name. It's a question I get asked, probably the most commonly asked question I get from new investors is, should I use the company? And the answer I give them is always, it depends, because you really have to look at your own personal circumstances. There are absolutely some times when using a company is a no-brainer, and it's definitely the better thing to do, in particular, if it prevents you paying 40% tax. But there are the instances where actually using a company doesn't make a massive difference, and it's really just down to your own personal preference as to what you use. Companies, there can be an added complication people are maybe not so keen on. Buying property in your own name is simpler, it's cleaner, it's easier. And for some for that reason, some people just prefer to use their own names, and they would happily pay an extra 1 or 2% more tax, whatever, if they do that. Others are like, no, I want to build a big portfolio. I'm not interested in. I want to use a company because I might move around. I don't want this to be taxable on me. I want it to be taxed in the company, etc. And that's absolutely fine. And then we can explore about using the company. But yeah, I mean, 2% is here to stay, unfortunately. But there's always things that, it's not as bad as it could have been. And one of the main things I say to people is make sure you claim those expenses, because the more you bring your profit down, the less tax you pay anyway. And if you qualify for the personal allowance, the £12,500, that's tax free per person. If you qualify for that, and you've only got the one rental property, it's possible, between that and having a mortgage paying interest, you could actually be paying no tax anyway. So the fact the rate goes from 20 to 22% becomes irrelevant if you're paying zero tax anyway. And quite a lot of our clients do pay zero tax. So, for some people, the tax increase will be meaningless. For others, it will be very important. So it's really down to a case-by-case basis. And that's where I come in, because I'm happy to chat to people, to discuss their own personal investments.
Yeah, so Richard, that just brings me on to a very good point. So the 12,500 allowance, I mean, people just have to take into consideration when they set up a company that if you have an intention to use that property yourself, then you should buy under your own name. But if you have the intention of actually being a completely, just investor, and that's it, you're a rental yield investor, buying under a company could work better for you if you're building a multiple property portfolio, because then you don't have the problem of ATID. ATID is something which I think people need to take into consideration. And as companies,
yeah. So when I sort of speak to people about using a company, one of the questions I will always ask is, what's your intention of this property? Will you always rent it, or do you think you might leave it as a holiday home, etc., use it yourself? And if someone says, I'm not sure, I might rent it, I might not, I might rent it now, I might move, I just say, well, put it in your own name. Because as you're quite right, the ATED, annual tax and envelope dwellings, is its full name. It basically applies under three circumstances. One, if you own through a company. So if you're owning your own name, it's irrelevant, you never pay it. But if you own through a company, the property is worth more than £500,000 and you don't rent it out, then you have to pay an annual tax, which starts about £4,500 a year, but obviously gets higher and higher the higher the value of the property. And this, of course, will be in addition to the mansion tax, as we'll cover on that later. So owning through a company, if you are going to rent it out the property permanently and have no intention of living there, then actually that's when using the company could well come in, because the ATED becomes irrelevant then. You have to claim the exemption every year, which is obviously we can do for you anyway. But just once a year claim the exemption. You won't pay the ATED, and therefore you're plain sailing using the company, locking down potentially those 19% rates. Be careful with the company. The rate does go up when you go above £50,000 in rental profit, but maximum rate in the company is 25%. So compare that to 40 or 42, 47% in your own name, using a company for multiple investments, paying a maximum 25%, definitely worthwhile.
Yeah. So I'm good. So that's something which our investors and clients can follow up later about how ATID would affect you if you are considering to buy under a company name. Now, I'd just like to bring Gavin in here, because Gavin is our finance specialist, and he's been working with a lot of investors who always ask the question, should I buy it under a company name? There's lots of sort of platforms that you can use now. Gavin works with all of these platforms. So if you're a buy-to-let investor, Gavin, coming into the UK market, of course, you've got a large portfolio of people buying under their own names, but how do you advise them when they want to set up a company, and what is the difference in the borrowing arrangements when you are actually borrowing under a company?
Yeah, thanks very much, Gareth. When it comes to borrowing in personal names, basically every lender is going to be happy lending to individuals, whether you're just buying it as a one person or whether it's with a partner or a friend or a family member. Lots of lending options available for that. In general, the maximum loan to value for international clients is 75% loan to value, meaning if you do want to invest in the UK, the minimum deposit required is 25%. We do work with a few lenders who can go slightly higher. Some at 80%. There's one or two at 85% loan to value as well now. So that just seems to be improving the product range and lending options available. For limited companies, there are a number of options still available. Not quite as many as personal name. However, you can still borrow up to that 75% loan to value relatively easily. Again, a few lenders offering 80%. For the buy-to-let mortgages, what lenders will usually do is they'll do a rental stress test affordability assessment, and for a UK limited company, it's almost always going to be at 125% rental coverage. So by that, I mean if your monthly payments were £1,000, your monthly rental needs to be at least £1,250 per month. That would be 125% coverage. So a wide range of lenders for those UK limited company borrowing options.
Okay, and any sort of ballpark interest rates that you should be looking at for those loans?
Yeah, so at the moment in personal names, in general, you're looking at a rate of somewhere between 4.5% to 5.5% interest rate. For a limited company, in general, we say it's about 0.5% to 1% more expensive. So really, you're looking kind of 5 to 6%.
Yeah, and then if you're buying under a personal name, it's between like 4 to about 5%, and if you're owner-occupier, you can dip below 4%.
So on the personal name side, for buy-to-let, the interest rates are about 4.5% to 5.5%. The limited company, which is going to be a buy-to-let mortgage, is about 5 to 6% in general. And if you're doing personal name for a self-use mortgage, like a residential mortgage, those rates can be as low as 4%.
Okay, excellent. Okay. So look, moving on to the next thing, we've also, big topic has been the high value council tax surcharge. This one's been sort of knocking about. It doesn't seem to be too much of a stinger for someone who owns a property of 2 million to 5 million, but there's obviously areas. So just so people know, that if you buy a property in excess of £2 million, there'll be a surcharge in 2028 of £2,500. And if it's in excess of 5 million, that'll be £7,500, and that will be effective on your valuation of the property today or 2026 value. That's over to you, Richard, how you see that.
Yeah, and I think there's going to be a revaluation every 5 years on the property as well. So those who are under 2 million now may still get caught in the future if they go above 2 million. I guess we'll have to wait and see what happens. I mean, my sort of question is who pays it? Because logically, you would say the owner of the property will pay the 2,500. That sort of makes sense to me. But of course, because it's going through as a council tax, well, when that property is rented out, who pays the council tax? Well, that's normally the tenant. So would the tenant end up with the bill of £2,500? Because if I was a tenant, I probably wouldn't be so happy with that. But I don't know. I mean, I think logically, owner would probably end up paying for it because it would make more sense that the tenant will pay the council tax, the normal rates, but the owner will pay the mansion tax. But until it all sort of comes into fruition in a couple of years' time, we'll have to wait and see. I guess some owners out there might be lucky enough that the tenant picks up the bill. Who knows?
Yeah, well, that's normal. I mean, look, do you see any of these taxes being reversed by the next government coming in? I mean, I'm being a bit presumptuous there.
Anything's possible. Anything's possible. I mean, things like a new government are obviously going to be looking to lower taxes because that's an easy way to win votes. Something like this absolutely has a chance it could be reversed. Stamp duties could be lowered, whatever. It's absolutely a possibility. We'll just have to wait and see. The next election will be latest 2029, so probably about 2020, a couple of years, 3 or 4 years, we'll probably start seeing people start releasing their policies, their plans, and we have to wait and see. I wouldn't rule that out being reversed, but we'll have to just wait and see.
Okay. Something else as well, like we were lucky enough not to see any changes to capital gains tax this time. That must be a welcoming one for you.
Well, yeah, I think the last couple of budgets, there have been these rumours going around about, I mean, I've heard quite a few rumours going around about aligning capital gains tax rates with income tax rates. So obviously income tax rates being at the time, 20, 40, 45%, and actually aligning capital gains tax rates to match that. Personally, I don't think it would ever happen. I think it'd be pretty crazy if any government tried to do it. And the reason I think it's be crazy is purely because in many ways, I see capital gains tax. It's almost like a voluntary tax in the sense that, yes, you pay it when you sell your asset. But of course, virtually all the cases, you will choose whether to sell your asset or not. So if you've got a property, you make the choice to sell it knowing that you will pay capital gains tax on your gain. So if you know the capital gains tax rate is going to be up to 40%, you just wouldn't sell your asset. What's the point of selling an asset and paying 40% tax? And that sort of tax rate, such a big increase like that would almost certainly be reversed on a new government. It would be a very, very easy policy to bring in, to realign the capital gains tax rates back to where it was. So whilst I can never say never, I'd be very surprised if those rates are increased. I mean, there were some rates were increased in the last budget. Non-property assets were increased to align with property assets. And the capital gains tax rate has been lowered. It was up to 28% at one point. Now the maximum rate is 24%. And hopefully it will just continue at that rate. It will be, because you'll find that the higher they push up the rate, it wouldn't necessarily equate to more tax collection because people just wouldn't sell their assets. And if anything, they'll probably get less tax collection. So I don't think they'll increase those rates anymore now.
Okay, good. I'm going to throw another question to Gavin there. Just wake him up for a second. Okay, so how do you reckon the autumn budget affected bank pricing and criteria for the mortgage products being offered in the market at the moment?
Yeah, good question. To be honest, at the moment, we haven't seen too much change. I'm obviously based out here in Hong Kong, same as you, Gareth. When there are changes to kind of the UK mortgage products, it usually affects the UK residents, the more domestic market first. So firstly, those reductions are seen in the self-use mortgages. Shortly after, they're in the buy-to-lets for UK residents, and then a couple of months later, it kind of leaks out to the international market. So as of right now, not too much has happened, but there is the next Monetary Policy Committee meeting on the 18th of December, and there is quite a high chance that actually there might be another base rate reduction. So base rate's currently at 4%. There is a lot of talk of it going down to 3.75% before the end of the year, which puts us in a good position. That means it's come down a few times this year. It's probably going to come down a few times next year as well. So if we can kind of be at the end of 2025 at 3.75%, with base rate at the end of 2026 around 3.25, maybe 3% if we're lucky, I think it puts the lending market in quite a strong position, makes things much more affordable on people's monthly payments, and puts the economy in a much stronger position at that point as well. But in terms of actual kind of changes following the budget, nothing really has happened at the moment.
Excellent. Okay, and look, this sort of brings on to the last question, that this mansion tax, or however you want to term it. I mean, how is that affecting the international purchasers from your side when it comes to looking at the finance? Obviously, there's some brackets going to start forming in the market.
Yeah, absolutely. To be completely honest, it hasn't affected things at all. It was more the uncertainty leading up to the budget for the last couple of months, which has kind of kept people from pulling the trigger. As soon as the budget last week happened, we've seen so many more people progress to exchange and those purchases for those higher value properties. So it hasn't made a huge difference at all. Realistically, if you're buying a property for £2 million plus, then a £2,500 fee at some point further down the line is probably not going to be too influential in your decision. So really hasn't affected the top end of the market at all.
Okay, Gavin, just to throw one more question. If I had to ask you which sort of levels of mortgages you've been looking at over the last, let's say, 2 to 3 months for buyers, what was the sort of average buy-in?
Yeah, good question. So I would say that if people are looking for those buy-to-lets, they're more looking at purchase prices under about £600,000. That's where the stronger yields are. You can get higher loan to values much more easily on those rental stress test assessments. So on the buy-to-let side, it's been kind of below that 600 grand. For people that are looking to buy for themselves as a holiday home, or for their children to live in when they're studying in the UK and in London in particular, then you're looking at those prices kind of 1.5, 2 million, 3, 4, 5 million plus. So it's kind of been a bit of a change. If you're going for those investments, usually it looks at the more modest pricing. When it is that self-use property, it's a bit more of an emotional attachment for people. So usually they're the higher value ones. But again, we can obviously get mortgages on all types of properties.
Okay, and just to throw it back to Richard, anything else you anticipate going into next year? Because it's, the government will probably reassess, how they position themselves for this budget, because I think they had to come with a soft budget this time. And they didn't look at things like first-time buyers and all that, and everyone's saying you need to help first-time buyers out. But do you anticipate any other key changes they might make actually to help the market?
Well, yeah, I mean, I think these last two budgets have been very much focused on we need more tax. They're always is talking about it's black hole. Is it really a black hole, etc. Where. So they've made no secret that they wanted to raise taxes one way or another over the last two budgets. They have done that now. I think that should be it in terms of raised taxes now. they can't keep on raising taxes because otherwise they'll be voted off very quickly at the next election. So they're going to have to stabilize things now for going forward. And if they've got any sense, they could even start bringing some taxes down ahead of the next election, just try to sort of, try and win some votes that way. So I think, property taxes are fingers crossed, with what happened in the last budget plus this one, I can't see any more increases coming now. I think we need a bit of stability. People know where we stand now. And then, if anything changes going forward, it'll hopefully be things coming down, not going up, because the pressure will be on, no doubt. Even just like the last Prime Minister's question the other day, they're getting absolutely savaged in the House of Commons with increasing taxes for everyone, and that's not going to go away. So they will have to, at the very least, stabilize things, and at best bring some taxes down. And property taxes are very good because property market's so important with the investment, with the economy. The more people buying, selling, and renting property, that's what drives the economy. Yeah, and they can do that by lowering and making property taxes, more affordable, invest more, in particular the overseas investment. It's so important to the economies. The government will know that. They might not miss it, but they know that. So I think they'd be very silly to do anything more going forward.
Yeah, absolutely. And I think, you look at some aspects of it where...
You know what? I would have given old Angela the correct advice. There's no question there.
I think that was a good roundup.
I think we've covered everything. Yeah. Yeah, thank you.